All right, welcome back to another episode of the Black Bullion Show. Currently, if you are saying it is a toss-up between investing in the S&P 500 and gold, well, I'm here to tell you, nah, it's not. It's not a toss-up at all. If you take a look at the price tag of where both are right now and where they should be, the S&P 500 is no bueno right now. Gold, on the other hand, couldn't be any more undervalued. Why? Well, find out shortly. But first, if you're new to this channel, please hit that big red subscribe button right down below. Also, please hit the like button. Helps to get this economic evangelism right on out there to the masses to bring more people into precious metals. Now, big shout out to Omnipotent Being. He's a viewer and he reminded me of this website that you're looking at right here called the usdebtclock.org. Definitely check it out. There's a lot of fun data on there to go through, but I wanted to specifically talk about gold's price tag, and we can also take a look at silver's as well and bring it into perspective. So as you guys can see here on the right hand side, the dollar to gold ratio should be $32,000.626. Now, if you took a look at this, you're probably like, how is that even possible? Well, this didn't just arrive out of thin air. They calculated this by basically taking the year-over-year increase in the US M2 money supply and then dividing that by the yearly world production of gold in ounces. So that's how they arrived at this $32,000 number. Now, the crazy thing is that's about 17.3 times what the current gold price is right now. But you know what's an even better, more undervalued asset? Silver. Silver should be $3,934. And if you take that and divide it by the current price, you'd get somewhere close to around a little bit over 170. So it's about 170 times more where we are right now with the price of silver. So definitely the metals are extremely undervalued when you take a look at how they arrived at these numbers using this metric. Now let's take a little bit of a deeper look into gold and see how and compare, if the S&P 500 or gold is the better bet. So let's take a look at this quick quote here from this new one from Kitco entitled, "Kitco or gold is a safer bet than chasing overvalued stocks, FXTM." So let's start. "Gold is a better option than chasing overvalued stocks," writes FXTM chief market strategist Hussein Syed. "With yields expected to remain low for a long time, inflation projections likely to head higher in the months to come, and geopolitical tensions on the rise, some great ingredients are present for the precious metal to continue attracting inflows," Syed says. "Gold is very close to its all-time highs of $19.20 an ounce and is looking ready for more gain. Only $50 away from the all-time high. It is only a matter of short time for the yellow metal to see a new record," Syed writes. In the meantime, stocks are continuing to ignore deteriorating US-China relations. So let's get a breakdown of where we are with the Shiller ratio and the S&P 500. So the average for, or better yet, before we actually get into the Shiller one, let's take a look at the Business Today article here entitled "Market Overvalued. Consider Shiller's cyclically adjusted PE, not regular PE to find out." So let's get into it, and then I'll get into why we're taking a look at the Shiller PE. So let's start here. A black swan event breeds exceptional outcomes, but when you analyze a trend, exceptions do not make for accurate conclusions. The Ronies-induced economic slowdown is a big aberration of financial year 2020 to 2021. Although the economy was already on a downturn before the Ronies gripped the country, the expected blip in corporate earnings and gross domestic product in FY21 and the rebound in FY22 can only be studied in silos. In that case, how will the most popular valuation metric, PE ratio, that relies on 12-month trailing and forward earnings per share depict correct market valuations? It cannot. This is why a lesser-known valuation metric, cyclically adjusted PE ratio, also known as CAPE, that takes into account average earnings of last 5 to 10 years, is what analysts are recommending to value stocks in the current scenario. This was introduced by Nobel laureate Robert Shiller. CAPE is also called Shiller PE Ratio. So that's why I mentioned the Shiller PE ratio. So let's take a look at that relative to the S&P 500. So if you take a look down here, the mean, the average S&P 500 is 16.72. If you take a look at where we are right now, we're almost double that. We're at 30.11. We're almost double that. And earlier in the year, we were even higher than where we were than where we are today. This is right before the Ronies hit, and that level is even higher than where things were on Black Tuesday, and we're about where we were when Black Tuesday hit back in the late 1920s. And of course, we're way higher than where things were on Black Monday. So we're very overvalued right now. Of course, we're not where we were at the top of the .com bubble, but we're slowly approaching there. We're pretty much right behind, or second in line to that record. So we're getting really, really close to that point. So according to the Shiller PE ratio for the S&P 500, we are definitely in overvalued territory. So again, there is no competition right now when it comes to gold and silver versus the S&P 500. Gold and silver are extremely undervalued, while the S&P 500 continues to be overvalued. But let me know what you guys think in the comment section below. Thanks again for watching. Please hit the like button. Please subscribe if you're new. It's Black Bullion.